Hello, everybody, and welcome. It's a beautiful day in Athens and the perfect day to talk about retirement strategies. I'm so excited to have with us today our founder at Elevate Wealth Advisory, Chuck Vickery. Chuck founded the firm 42 years ago as Elevate Wealth Advisory. He's the biggest Georgia fan you'll ever meet and the wisest person I know. I've learned so much from Chuck through the years, and this presentation is one of my favorites that he does because it really breaks down how to save for retirement and, more importantly, how to start spending your retirement as you move through the different phases of life. So, welcome, Chuck.
Hey, Betsy, good morning. Good seeing you.
Good to see you.
So actually, Betsy, one correction. I started the firm as Vickery Financial Services,
That is true.
and then we changed the name to Elevate Wealth a few years ago. So the joke
And
around
then
the
you
office,
changed your name to Chuck Elevate.
so that's the joke around the office. So uh, actually in 2018, I went into semi-retirement. And at that time, uh, I had a good bit of time on my hands, even though I was still working a little bit. So I started trying to put together some ideas. And we originally called this spin down simply because there's comes a point in your life where the government forces you to spend your money or at least pay taxes on it. And so it has evolved from that into a multi-generational wealth program. And we now call it strategies for retirement transitions. Now, strategies for retirement transitions is a tool for not only achieving, but also for maintaining financial independence. It's designed to help people have better outcomes. So it increases the odds of you not running out of money while you're living the life that you desire. And by lowering your taxes, your portfolio continues to grow. So there are four stages in this. And the first stage is accumulation. And accumulation is where you build a smart foundation for the future. And accumulation begins when you get your first check, and it ends when you get your last check. And when you get your last check, you transition from accumulation to transition. And transition is the stage where you preserve your wealth while volunteering to pay taxes. It's a very short stage because it starts when you get your last check and it ends either at 70 or 73. And then after transition, we go into distribution. And this is where you are funding and maintaining your lifestyle from all the assets that you have accumulated. And distribution lasts as long as you do. And our goal is to have your money outlive you. But at the end of distribution, at the end of life, we have legacy. And legacy is where you plan for your heirs and your charitable causes. Now, looking at this screen, you'll notice that everything on here is not about investments. It's about life and health issues and things that you should be doing to help you live a better life. We have investment in here. We also have taxes on each stage. We have estate planning, and we have risk management on each stage. And if you notice this hump, if I can find my mouse there, you'll notice when we start, we have very little money. And as we go through accumulation, our assets increase. And then there's a very short transition period. And then we start distribution. And then we end up in legacy. And then down at the bottom, you'll see these stars. These are collaborative moments. While we do a lot here, we're not attorneys, we're not CPAs, we're not insurance agents, we're not mortgage brokers, and we have to bring these people and other experts in from time to time. So this takes you from, it's basically from your first check through death. So we're going to take the next few minutes and run through about 70 years of your life. And so what can you do with money? Well, there are four things you can do with it. You can spend it, you can give it to your heirs, you can give it to charity, or you can give it to the government. Now, most people would prefer to do 1, 2, or 3 rather than 4. And people enjoy spending money for things that they want. But sometimes you're forced by the government to spend your money. And our goal is to show you smart ways to position your assets so that you have as many options as possible for how and when you spend it. And we all love our children, but we don't want the tail to wag the dog. We don't want to lead such a Spartan life just so we can leave assets for our children. We want to contently live the life we envision and enjoy life. And when we're gone, if there's anything left over, that our children are welcome to it. However, some ways of giving to our heirs are better than others, and we're going to discuss that. And for those of you that are charitably minded, there are multiple ways to make gifts, and we'll discuss ways that will help your favorite charity, but also benefit you the most. And while most of us do not mind paying our fair share of taxes, we don't want to pay our share plus someone else's. So in today's discussion, you will find ways to help lower not only your taxes now, but the taxes in the future and the taxes for your heirs. And so one of the things I like to do is I like to show people this picture. This is a jigsaw puzzle. And I'm sure that several of y'all have done jigsaw puzzles. So my question to you is, when you get ready to put together a jigsaw puzzle, what are the first things you do? Well, people normally get the straight edges together, or they get the colors together, and they're working on it. But they often take the box that the jigsaw puzzle is in, and they set it over at the side of the table. And they do that because they want to look periodically at what are we trying to, what's the end result going to be when we get this thing put together? And are we on track? So when we do planning, we like to do the same thing. What does the end result look like? So rather than starting with accumulation, we're going to start with the end result, legacy, and let's see what we end up with. So legacy's goal is to positively impact your wealth on the lives of others. And each one of these phases, we have about 12 or 15 bullet points. And one of the questions that I don't get as often now as I used to get is, are we going to have to pay any inheritance tax? Are we going to have to pay any estate tax? So let's talk briefly about that. In 2000, if you had more than $675,000 in assets, everything above that, federal government got 50% of it. George W. Bush was elected, and he increased the federal estate exemption up to $1 million, actually all the way up to $3.5 million. Obama was elected in 2008, and he bumped it up from 3.5 to 5 million and added cost of living adjustments or inflation adjustments to it. And it got up to over $5 million. In 2018, Trump came in and he doubled. So, and left the cost of living on there. So you can see these numbers are quite high. So right now in 2024, every person in America can die with $13,610,000 and not have to pay any federal estate tax or inheritance tax. And a couple, that's $27.2 million. So what we have found is very, 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 very few people are impacted by this tax. Now, the Trump Tax Cut and Jobs Act is set to expire January 1st of 2026. That's about a year and a half from now. And if it does expire, these numbers get cut in half. So rather than having $28 million per family, we'll only have 14 million. So what does that mean? That simply means that rather than really nobody having to worry about it, it's just really nobody has to worry about it. So a small number doubles, but it's still an extremely small number. So we're not really going to talk a whole lot about estate taxes because most of us aren't concerned about it. But today it's all about income taxes when somebody dies. and you have to file that final tax return. And there are things that you've often heard, don't make any major decisions in the first year. In certain things, that's very appropriate, but in other ways, that's awful advice because there are things we want to take advantage of on that final tax return. For instance, if someone is married when they die, this is the last year that their survivor will be able to file a joint tax return. Maybe we should accelerate some income into that tax return because the tax brackets, we call it the widow's penalty. The tax brackets are getting ready to expand dramatically for the survivor. If someone has deferred double E bonds or I bonds or annuities or something else where they've had deferred income, maybe they want to go ahead and recognize that on that final tax return and pay a lower tax rate than they would if they wait, especially if the asset is ultimately going to end up with the children, and the children are in a higher tax bracket than you are right now. So when a person dies, broadly speaking, their assets are split into two nice big groups. One group is called income in respect of the decedent, and this group does not get a step up in cost basis. The other group is everything else that you own, and it does get a step up in cost basis. So here are two asset classes at death. So the decedent's got assets. You have the income in respect of the decedent. That's not a word you normally use or a phrase that you normally use, but what it means is you have some assets that the government has allowed you to postpone paying taxes on or has deferred some taxes. All other assets are things that you own. So what is a step up? A step up means that you paid money for something and today it's worth a lot more than you paid for it. And at your death, what you paid for it basically becomes its current value as far as taxes are concerned, so that your heirs could sell it and not have to pay any taxes at that value. So I'll give you an example. Mom and dad bought a house in 1975 for $45,000, $50,000. Today it's worth $500,000. Dad died a few years ago. Mom died. The children inherit the house. Even though it's got a $450,000 appreciation, they can sell it today and there's no tax on that. If they hang on to it for 10 years and it doubles in value again, the first $500,000 is still tax-free. You would pay taxes on the appreciation. Or maybe you put $10,000 in Microsoft in 1982 and it's worth $10 million today. Well, if you sell it, you've got to pay tax on that $9.9 million. But if you die, your heirs can sell it the next day. The entire $10 million is totally income tax free. So we have what we call the tax buckets. And I sort of want to show you about this income in respect of the decedent, if I find my mouse. This first bucket is the tax deferred bucket, and those are IRD assets, income in respect of the decedent. And you'll see things on there that give you deferral: 401k, 403b, 457, various retirement plans, traditional IRAs, simple IRAs, SEPs, annuities, pension, EE or I bonds, or net unrealized appreciation on stock. So the thing about these is they've never been taxed. So when you take money out, you pay tax and you pay it at the highest ordinary rate. And at your death, your heirs receive it. And they still pay tax at it at their highest ordinary rate. And if they still have it at their death, their beneficiary pays tax on it. There is no step up in basis, and these assets are essentially taxed forever. The middle bucket that has brokerage accounts and savings accounts and real estate, the things that you own personally that are not retirement plans, that are not giving you tax deferral, these are the assets that step up in basis. Okay, they contain after-tax money, not pre-tax money. And these assets do step up in basis at death. And there's no tax to your heirs on this if they liquidate the asset at your death. There's a third bucket on there. This is our tax-free after-tax bucket. These are the Roth accounts. And these are accounts where there's no tax on the dividends, no tax on the interest, no tax on the growth, and there's no tax, no income tax when you take the money out. No tax for you, no tax for your heirs. So, the question I ask people is, if you were going to inherit $1 million, which one of these buckets would you like for it to come from? Would you like for it to be from the middle bucket or the bucket on the right? So we want to transfer assets as efficiently as we possibly can. So with that in mind, when we go back and we look at legacy, you're going to find that decisions that you make at age 30 or 40 are going to have a major impact on you at 80 as well as your heir. And when the government offers you something for free, raise your hand. And tax-free step up in basis is one of the things that government offers. So make sure you've got some planning so that you're able to take advantage of it. And so one of the first things that we have on here that I've got highlighted is equalize ownership of equities while both spouses are alive. Because we don't know which spouse is going to die first. And we want to get a step up in basis at the first death of the surviving spouse. Because then the surviving spouse has basically tax-free money on which they can live. Another thing I've got is provide the family a double step up in basis. So we want another step up in basis at the second death for the heirs. So let's get that double step up in basis. And remember, to get a step up in basis, you must own assets in that middle bucket. The goal here is to have income producing property that grows and increases in value, creating unrealized gains. Now, it may be a stock, it might be real estate, it might be a mutual fund, it might be an ETF. It's something that's doubled or tripled or quadrupled more in value. And you don't have to pay taxes on appreciation. You have to pay taxes on appreciation when it becomes realized and you sell it. But until you sell it, you don't have to pay taxes on that. So we need to get assets positioned so that we can end up with some unrealized gain. In addition to that, if we are holding things in that first bucket, we want to consider holding deferred structures to fund our end of life costs. Well, what do I mean by that? Well, the biggest expense you're going to have in retirement is going to be income tax. The second biggest expense that you're going to have in retirement may be long-term care. So there are only a couple of ways to get money out of that first bucket without paying taxes on it. And one of the ways that you can do that is to take money out of that pre-tax bucket, that IRD bucket, and pay for your long-term care or end-of-life expenses. So medical expenses are deductible. So if we take money out of our retirement account, it increases our income. But because it's a medical expense, we get to deduct 97.5% of it. While it's not totally tax-free, the taxes on that withdrawal are negligible. So it is a way to get money out without having a big tax bill. And it's a lot better to use that money than to use other dollars that you've accumulated to pay for end-of-life costs and long-term care needs. And then in 2019, right before COVID, the Secure Act was passed. And Secure Act made a couple of changes. The first change it made was you no longer have to start taking money out of your retirement account at 70 and a half. You can wait until age 72. Well, since then, Secure Act 2.0 has passed. And now the earliest you're forced to take money out of your IRA or your retirement account is age 73. Another change that was made that impacts us maybe even more than that is simply the fact that children used to be able to inherit their parents' IRA and what we call a stretch IRA. So if you were 45 years old and you inherited your parents' IRA, you took money out every year for the rest of your life. So you had 30 to 40 years to take that money out. Now you've got 10. So what the law says is if you're a non-spouse, if you're a child and you inherit an IRA, you have to empty that IRA and pay taxes on it by the 10th year following your parents' death. So when we look at that, one of the things that we think about is if you have the resources so that at your death, your surviving spouse could comfortably get along, be content, be comfortable, stay in their own world without all of your IRA money. Maybe we ought to make the children co-beneficiaries of the IRA along with your spouse so that at the first death, the children inherit an IRA. And then at the second death, which may be 3 years, 5 years, 20 years, who knows, they get the rest of it. And what that does is that gives your children 2 10-year periods. And I think 2 10-year periods for successful children, because the last thing successful children want to inherit is an asset that's full of taxes. But if we can give them 2 10-year periods, we're better off. Speaking of successful children, if your children are in a high tax bracket and you're in a relatively low tax bracket, maybe you should just take out more money than you need from your IRA. You don't have to spend it. You can take it and put it in that middle bucket or put it someplace where when they receive it, it will not be taxed a second time. And then the other thing we see about IRA, when we're reviewing people's wills, it's not unusual for us to see that they've left X amount of dollars to the church or their favorite charity. And when you pass an asset along through your will, it's usually an asset that has a step up in basis. So what we recommend to a lot of people is, look, let's go back and take a look at your overall situation. And if you want to leave a charity $50,000, let's say, maybe it's better to go to your IRA and name the charity in your IRA to receive $50,000, and then take your will and have it payable to your heirs. And I'll tell you where this came from. We had a client that was leaving his house and his investments to a charity, and he was leaving his IRA to his 2 children. Well, he sort of got it backwards. Why? Because the charity doesn't have to pay any tax, and the children do. So we went in and flip-flopped that. He's now leaving his IRA to the charities, and they get that money totally tax-free. That's the second way you get money out without paying taxes on it, if it's left to a charity. And then the children receive the house and the investments that stepped up in basis. So the children got the entire $1 million, not $1 million with a tax bill attached to it. So that's one of the things that we recommend that people do there. And we're not going to touch on all these because we don't have time. So we go into distribution. So now we're in the next stage. So here you are, you're at least age 73, and you're taking money, and you want to take it in a tax efficient manner so that you can increase the longevity of your plan and the value of your assets. So everyone focuses on accumulation. All you hear about is defer, defer, defer. Defer taxes with your retirement plan, defer taxes with an annuity, or with life insurance, or defer with government bond. Very few focus on when you start spending down your money. And this is in your force at age 73. You don't have to spend it, but you've got to take money out of your accounts, your retirement accounts, and pay taxes on it. So what is your tax bracket going to be when you're in distribution? You need to project out 20 years or so just to see what your tax bracket is going to be. If you do not know what the future tax rate is going to be, how do you know whether or not you ought to be doing deferring? And if you don't have a plan for how you're going to book these deferrals at a lower tax rate, then maybe you shouldn't even be deferring in the first place. So often people tell me, look, I'm just going to live off my dividends and my interest and not spend the principal. Some people don't understand that you're forced to take this money out, because when you have distribution, deferrals end and taxes begin. Deferrals postpone taxes, they do not eliminate them. So the challenge is, how do you maintain your lifestyle and lose the least amount of wealth to taxes over multiple generations? And one of the best ways that we know of to do that, and I've got it highlighted in yellow here, is to focus on after-tax risk-adjusted market returns. This type of investing takes the surprise out of a large spike because your investment manager decided to make a substantial change to your portfolio. And we'll talk more about the best type of investments later in this presentation. And then, while the Secure Act changed when you have to start taking money out from your retirement account to your IRA in particular, page 73, it did not change the qualified charitable distribution. Now, basically at age 70 and a half, not 70 and a quarter, not 70, but at 70 and a half, you can take money out of your IRA for charitable giving and give it to a reputable charity, and you do not have to include that money as income. So it's called a qualified charitable distribution. And you can take quite a lot. This year you can actually take up to $105,000 per person from your IRA, but it has to be from an IRA, not a 401k or a 403b or any other type plan. So you don't have to pay tax on this money. So it's what we call an above the line deduction. So you not only don't have to pay tax on your charitable gifts, you still get the standard deduction. So the end result is you pay less in income taxes by donating the charities from your IRA than you would if you wrote a check or something else. But you have to have an IRA to do this. And speaking of taxes, you may not know this, but there's 3 ways you can get a zero tax rate. I mentioned the standard deduction. For people married couples under 65, it's about $29,000 this year. Married couples over 65 is $32,000. So the standard deduction and single people are half that. You don't have to pay any tax on that. But if your income is at a certain level, you may not have to pay tax on, remember the bucket that had qualified dividends and capital gains being a tax preference item, you may not have to pay tax on that. So what I want you to realize is that you can have a pretty substantial income and maybe not pay tax on all of it. So this was an actual client. Their income is about $124,000. But I want you to realize there's 2 types of taxes. There's ordinary income, and that's what you've paid all your life, your W-2 or your 1099. If you have interest, if you have rent, if you have bond income, bank income, all that stacks up, and that tax is ordinary income. And then there's capital gains and qualified dividends income. Capital gains is an asset that you've owned for more than 12 months that you sell and make a profit. And then qualified dividend income are the dividends off of common stock. Well, again, this client had about $125,000 income. They were using their IRA to make charitable gifts. They got the standard deduction, and they had $11,000 of capital gains and dividend income. So on the standard deduction, they paid no taxes. On the first $20,000 of taxable income, they paid 10%. They had another $41,000 of income that they paid 12% on. So they were in a 12% bracket. But look at the bottom, capital gains and qualified dividend. If your taxable income is under, and this year, this is last year's number, this year slightly higher, about 90,000. Notice that $11,000 of income they had. They paid no tax on that. So that's pretty good. That helps. But even if your income, so you can be up to about $126,000 this year and not have to pay tax on capital gains and qualified dividends. But even if your income does exceed that, and this is a client with about $180,000 of income, and you see after the standard deduction, their ordinary income was $137,000. So now they're in a 22% bracket. They made $9,000 in capital gains and dividends. Well, if it was just regular income, they'd pay 22% on that $9,000, but it's not. So they're getting a tax preference item, and they're getting about a 35% discount on that tax. They're only paying 15%. So we like these tax preference items. We like paying less tax. We don't mind paying our share, but if I can get a 30 or 35 or 40% discount, if you'll notice that under ordinary income, the highest tax bracket is 37. Under capital gains, the highest tax bracket is 50. So for very high income people, it's a 50% discount. So we've got these two different types of income. So when we're talking about taxes, when you reach this stage of distribution, you have very few options. Your hands are tied. You have to start your Social Security at 70 because you don't get any benefit from waiting. And you have to make withdrawals from, excuse me, your retirement's counted at age 73. So you're forced to pay taxes on this money, whether or not you want it or whether or not you want to spend it. The challenge is how do you maintain your lifestyle and lose the least amount of taxes? Well, one of the ways is this identify non-portfolio 1099 income. So what that basically means is if you have stocks and bonds in a traditional personal or joint portfolio, and if you're living off your investments, have your dividends and capital gains paid in cash. Whether the dividends are reinvested or taken in cash, they're taxed exactly the same way. We just don't want you reinvesting your dividends and having to take more money from someplace else that is subject to ordinary income because you're reinvesting those. So we recommend that you take your dividends and your capital gains in cash and use them to support your regular income stream. And then you'll notice that I've also got determine your Social Security strategy up here. So just because you can start your Social Security at 62 doesn't mean that that's the best time to begin taking your benefits. So we actually have programs that can help you determine the optimum starting date for you so you can get the maximum payout from Social Security for you and your spouse. So that's the distribution phase that we've been looking at. And again, you can do things to save on taxes, but you don't have nearly as many options in this phase as you have before. So when we get into transition, now remember, transition is when you get your last paycheck and before you turn 70 or 70 and a half. This is the stage where the magic happens. Now is when you can fix some of the things that you wished you had done earlier. When people reach this stage, they're tired of paying taxes. They've paid them all their working years, especially the last few years when their income was the highest it's ever been. And guess what? Their taxes were the highest they've ever been. They think they've finally gotten to a period when they don't have to pay so much in taxes. When you first retire, you aren't forced to take Social Security. You aren't forced to take money out of your retirement account. And if you're living off your savings, this is a happy period. Taxes are minimal, if any. What people sometimes fail to realize is that huge income taxes are looming in the future. And now is the time that you can voluntarily pay taxes at a very low rate. Remember those 10% and 12% rates we talked about a minute ago? So I don't know if anybody thinks that income tax rates will be lower in the future, but I don't. And the winner is not the person who pays the least amount of tax this year. is the person who pays the least amount of tax over their lifetime and the lifetime of their children. So, and you'll notice again, this is a very short period. Okay. So I've got a few things highlighted here. So during transition, the objective is to design a strategy that minimizes the tax liability over the long term, not just for current years. Okay. This is where we can maybe fix mistakes that we made earlier. Maybe now is the time to end deferred income. So, or in deferred gains, maybe you have an annuity or some government bonds or some type of deferred compensation. But rather than starting Social Security, taking money out of your retirement account, when you have no income, take all those things that are taxed at a very high level and maybe pay taxes at a very low level on those. We think it's important to estimate your in-retirement tax rate because now maybe you can create a tax strategy for the rest of your life. So we've got estimate entire in-retirement tax rate, optimize tax strategy for life after work, realize income before 73. Maybe you don't have any deferred accounts, but you are deferred annuities or government bonds or a deferred compensation plan. And maybe you don't need to take money from your retirement accounts, but maybe you should. And again, what I say, you can take up to $126,000 in 2024 and not exceed the 12% tax bracket. We just want to make sure we don't waste those low tax brackets. So even if you don't need the money, maybe take out some. If you do need it, maybe you can take out more than you need and pay a low taxes on it and go from there. This is a very short window of opportunity, 3, 4, 5, 6 years, where you can make some pretty dramatic changes at a very low tax cost. And one of the things that you can do is you can explore Roth conversion strategy. Well, what is a Roth conversion and how do they work? Well, a Roth conversion, to put money into a Roth, you need certain things. To make a contribution, you need to have income, but you can't have too much income because if you exceed 200,000 or so in income, you're not authorized to make a Roth contribution. But you can do a conversion regardless of income. And how you do a conversion is you have your retirement account send money to the Roth account and you pay taxes on that amount of money. So you take money that is going to be taxed forever into it's taxed one time and never taxed again. So you volunteer to pay taxes while you're at a low rate, but by lowering the amount in that pre-tax account, your future required minimum distributions are reduced. Your future taxes are reduced. Your future tax-free transfer to your heirs is increased. So this is an opportunity that you don't just temporary low tax rates. You want to make sure you utilize it. And if your children are in much higher tax brackets than you, this is a great way to sprinkle income onto your lower tax bracket. So how does it work? Do you have to do it all at one time? No, you don't. We often, it doesn't need to be an all or nothing. So one helpful approach that we call filling up the buckets. So you can see before conversion, the 10% bucket's full and the 12% bucket is full. But the next bracket is a 22% bucket and it's only about half full. So what would happen if we did a Roth conversion to fill up that 22% bucket? Okay. This could be $20,000, $50,000, maybe $100,000 that you could convert, and you've locked in the tax rate at a rate that's probably going to be lower than in the future. If you plan to convert a large IRA, this approach, doing a little bit every year, is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA contributions over a number of years, filling up the tax bracket bucket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period of time. So before we get into transition, we're doing what? We're working. And we're in the accumulation phase. And this is our savings and investing time where we set the foundation for your future. So the adage here is to save as much as you can as early as you can. However, you should match the tax ramifications with the asset location. So we've got save as much as you can, but make sure you utilize the tax deferred bucket, the tax-free bucket, and the taxable account. And we want to match ordinary producing income assets with ordinary income structure. This lowers your future dollars of your required minimum distributions, and it positions equities for capital gains rate and for tax-free step-up. So many pre-retirees believe taxes in retirement are beyond their control, when in fact, things can be done, again, in your 30s or your 40s, that will impact you the rest of your life. 90% of retirement savings nationwide are accumulating without consumers understanding the impact of taxability or asset location. So, insight into the power of asset location is a critical value add to any prudent financial plan. So, asset location, this is where you put things that generate high ordinary taxes into the tax deferred account, and assets that generate tax preferences in the taxable account. So let me show you what I'm talking about here. So basically what we want to do is we want to match assets to how they're taxed. So you've got an asset allocation. You've got stocks, you've got bonds, you've got some cash. So it sort of depends on where you're putting them, okay? And I can't tell you how often people come to see us, and in their tax deferred ordinary tax, it's full of stocks. And in their personal accounts, it's all savings accounts. And they may or may not have a Roth IRA, okay? So in the Roth, you want to hold the highest expected return asset that also creates taxes. We want to use this tax advantage or middle bucket for personal, for tax efficient assets to accumulate unrealized gains and give us tax preference while we own it, okay? And then we want to use the tax deferred bucket for the most inefficient asset. So if you've got something that creates ordinary income, CD, bond, real estate, and I say real estate mutual funds or ETFs, because those are not qualified dividends. We want to put those in our tax deferred ordinary bucket. And we want to take our stocks as much as we can and put that in our tax advantage bucket. Now we've got to keep some savings for emergencies, and that goes in this middle bucket. But don't just load up your middle bucket with nothing but bank accounts. Why? Cash is taxable the year you receive it. Okay? And there's no unrealized appreciation. And when you put stocks in a tax deferred account, it doesn't make any difference what you put in that account. When it comes out because of the tax deferral, you don't get the capital gain. Remember, income in respect of a seat does not get a step up in basis. So when you put stocks in that first bucket, it's fine. But you've got to be careful. Some people are so good at accumulating money, they accumulate tremendous retirement accounts, which creates tremendous required withdrawal and tremendous taxes for their heirs too. So proper asset allocation, putting bonds in things that create taxes in the first bucket and things with tax preference items in the second bucket, So if we got a 60-40 portfolio or a 70-30 or 80-20, it doesn't make any difference. When we get through, the net return is the same regardless of where we put the money. It's the taxes that change. So proper asset allocation lowers your taxes today, it lowers your taxes in the future, and the tax that your children and grandchildren will pay. And people just don't pay enough attention to this. In addition to this, we want to manage risk. We want to manage risk by having a globally diversified portfolio. So if there's any such thing in the investment world as a free lunch, it's a diversified portfolio where you have large, small, U.S., international, lots of different things in your portfolio. Don't have all your eggs in one basket. And then unrealized gains. We've been talking about these unrealized gains. How do you get them? To get the step up basis, you have to have these unrealized gains. And there's so much evidence out there that support that if you will invest based on academic research, that you will accumulate growth in unrealized gains. Evidence-based investing helps you stay committed to your investment philosophy. It's the only way to accumulate unrealized gains is ultimately a step up in basis. Market timing does not work. Active trading does not work. But academic research, evidence-based investing does. Many pre-retirees are now finding out that they can control their taxes. In fact, actions can be taken at every stage in life to reduce taxes. So insight into the power of asset allocation is a crucial add-on. Okay. Well, let's look at one more thing. So this is our last point. Accelerate deductions. You can make a significant impact on your future taxes when you're late in your working career. Your income is at its highest. Your taxes are probably the highest that either one have ever been. So manage tax bracket creep by accelerating deductions. How do we accelerate deductions? By maxing out your retirement plan. If you're participating in a 401k, it's about $30,000 this year that you can put in. And if you're charitably inclined, we can do a donor advisor fund. A donor advisor fund is basically a charitable fund that you set up for yourself, similar to a foundation. You put money into it, you get a tax write-off for it, but the money can be handed out as you see fit over time. You don't have to immediately give that money, and you maintain control of how it's invested. So let's just say that you're 63 and you're retiring, and you give $10,000 a year to the church. Well, when you're 70 and a half, the best way to do that is from your IRA. Why? Because you don't have to pay tax on that $10,000. But if you've got 8 years or 7 years, you could make a gift now of $70,000 to a donor advised fund and get a big write-off right now on your taxes while they're at the highest amount. Okay. And the best way to do that is not with cash, but the best way to do that is with an asset in that middle bucket that has appreciated and has unrealized gains. And when you do that, when you make a gift with unrealized gains, you avoid paying capital gains tax. You receive a tax deduction, and your future charitable gifts while you're retired and not working have already been set aside, so you don't have to worry about that coming out of your current income. Okay. We talked about a lot of stuff today, and we went over it very quickly. So the 4 stages: accumulation, transition, distribution, and legacy, plus asset location. Okay. I hope you found this to be of interest. If you're already a client of Elevate Wealth and there's something that I touched on and you'd like to do a deeper dive, just ask your advisor to go over this with you. Everybody here can do it. If you're not a client and you would like to explore any of these options any further, just simply give us a call and we'll be glad to help you. Now, I forgot to tell you at the beginning, if you had questions, you could click down at the bottom and ask. So Betsy, I don't know if anybody asked any questions or if
Yeah, we do have a question. When is the best time to do a Roth conversion?
it used to be that you could do a Roth conversion early in the year and then late in the year, if for some reason it didn't look like it was a good idea, maybe you were going to be in a higher tax bracket than you thought, or maybe it was just a bad year for whatever your investment was in, you could uncharacterize that as if it never happened. They changed the law with the Secure Act. So now when you do a Roth conversion, it sticks. So if the market goes down, you're stuck with it for that year. But we aren't really doing Roth conversions just for 1 year or 2 years. We're doing it for the long term. So I would think that the best time to do one is as early in the year as possible. Why? Because it gives that money that much longer inside that Roth account. And over the last few years, most of the Roth conversions we have done have increased in value so that even including the taxes, the people are still ahead. But all things being equal, I would say early is the best time to do a Roth conversion. I think early in the year is the best time to make an IRA contribution because you've got that whole year for that money to grow tax deferred. I think on your 403B, your 401k, your 457 plan, the earlier you can get that money in on that, the better. Okay.
Okay. And then a follow-up question to that. So there is a limit to how much you can put in a Roth per year, but when you're converting, is there a limit to how much you can convert?
No, there is no limit. You can convert your entire account. The problem is you've got $500,000 in an IRA and you convert it, you're looking at about a 45 to 47% tax. Whereas if you do that $50,000 a year for 10 years, you might be looking at a 25% tax. So the examples that we went over is from some software that we have. And if your client, I hope you're sending us your tax return via email, or you drop them off and we'll copy them. And then we're going in and looking, is there anything that we can do? Would it be beneficial for you to do a Roth conversion at this rate, at your current income level? And if so, what would it cost? And if not, why not? So also, are we positioning the assets so that you're getting this preferential tax treatment the way that we should? So
Very
good.
Thank you. Those were all the questions. I'm going to go ahead and share my screen and to show you all.
Do I need to end it?
Pardon me?
Do I need to end my sharing?
Nope, I think I've got it.
You
So,
got it. Okay. Thank you, Betsy.
yes, thank you so much, Chuck. That's always my favorite presentation. I always pick up so many great nuggets. But you all can go to our website. If you have any questions, you can just go down to our chat box, our contact us button, and you can send us an email, or you can just send it directly to me at marketing@elevatewealth.com. I also wanted to show you, we have our YouTube channel. This video will be up there later today. We also have a weekly YouTube series called Elevate Wealth that we have been putting out for a couple years. It's just 2 to 5 minute long videos covering different topics. So that's always fun. Be sure you can go and subscribe to that. And then we've also turned it into a podcast. So whether you are on Spotify, Apple Podcasts, however you get your podcasts, you're most likely able to hear us there. Just look for Elevate Wealth. And then finally, our Facebook page also lists all of our upcoming events. Just go to our events tab and you'll be able to see other upcoming webinars that we have. Chuck will be back with us in July to talk about retirement planning for boomers, and we're looking forward to that as always. So thank you, Chuck, for joining us today. And I hope that you have a wonderful trip this summer. I hope all of you have safe travels if you're going anywhere fun. And please reach out if we can help you with anything.
Thanks, Betsy.
Thanks, Chuck. Have a great day.